So let's take it back, right? So founder-led, yep, understand that one. Been around for a while, brought it to IPO.
Yep.
Now moving towards, right, effectively almost a different set of infrastructure as well.
Yeah.
I do agree, and I think that's completely fair that the association with BIP, the asset management firm, it's always there at the back, right? It's like, hey, I want to bid for this, but don't worry, I got those guys. If anything goes wrong with me, or if I need some help,
right. Yeah,
I've got that backing.
You've got that backing. Yeah. And so I think that is the key, because they bring their expertise to maybe an asset owner. They'd be a bit more comfortable working with the Brookfield infra just because they have so much more experience. So if someone says, if a company wants to sell one of their assets, there wouldn't be as much pushback from that actual particular asset and its employees, because Brookfield Infrastructure has that record of coming in and helping the operations turn around and also generating a higher return on investment. And so in terms of like the internal rate of return and what they're looking at in terms of return on invested capital, they aim for about 12 to 15% return on invested capital for their projects. And they have a very structured mission. So, I mean, I think we were also talking about mission, vision, but what they look at is they have a structure in terms of how they look at the payout that they want to increase every year. And so they aim to do 5 to 9% every year, a dividend compounding. And that has compounded at the higher end, right? That's compounded about 9-10% over the past 13 years. Right. So there's that. And then they think about what's the FFO payout ratio. I don't want to be over leveraged. So they're super conservative in the payout. They don't want the payout of FFO in terms of the dividend to be sort of in the 90s, hundreds range, right? So the actual FFO payout in the last quarter was around 69%, but they want it to be in the range ideally of 60 to 70%. So they're getting there. They're averaging into 69 now. And so they have very, very specific targets on how they want to achieve things and how they want to grow, funds from operations. And they've managed to grow funds from operations at a 15% CAGR over the past 13 years, right? Wow. So that's an impressive.
That's what they estimated?
They've done over it since 2009. Yeah, they've estimated it's been about 15% growth CAGR, like in FFO, funds from operations. Yeah.
And that's their motivation then, right? So it's, I need to pay out this much, therefore I need to look at the investments that will make me.
We'll be making, And how are we going to recycle and reinvest capital that we've gotten from asset sales? And are we going to be able to just don't pay a dividend if you can earn a higher return on that capital where you reinvesting it, right? So these guys, that's their whole business model. It's basically they still pay out a dividend, thankfully, but they also reinvest that capital because they see when they get that money, they can reinvest that capital at a higher rate of return in other projects that they've been doing due diligence on, right? So that's what they aim to do.
Got it. Then the question begs, right? Why even give dividends?
Yeah. Well, I mean, I think mainly because there is that ownership aspect from Brookfield Asset Management. And so in a way, when I think, I did Next Year Energy Partners a few months back with you guys, and that was the subsidiary of Next Year Energy. And it's more of a cash cow for Next Year Energy. So they both benefit, right, from those relationships. So Next Year Energy Partners becomes a dividend payer to Next Year Energy. And so in the same way, I think you've got those really regular contracted cash flows that are coming in. And if they can sort of pay that out to Brookfield, asset management, I think that it works for them. And you're getting that growth with that dividend aspect to it as well. So I think that's the key. I think if they paid out everything, I don't think they could deploy that much capital. That's probably the problem. There'd be too much capital to deploy. So they're looking at using debt. They're looking at using, equity issuance to raise capital to buy things, but they don't need to use the funds that they generate from operations to buy assets or to reinvest.
Okay.
Yeah.
Cool. I think, diving down into or really understanding what you just brought up, right? So I feel it's a good idea to be giving some dividends because you need to be giving some incentive for your stock.
Yep. Right.
Really, that's the answer. Infrastructure is a long game play. Nobody's going to buy now and sell in 3 months' time.
Right.
That I hope no one's doing.
Yeah.
For anyone that is buying this stock. So keeping them there just as a form of, hey, you know what, is a good method. Is the way that I feel, right? Besides even asset management. The other thing is when they do invest, and here comes the critical bit, how much of it is equity, how much of it is debt? I know that they raise some sort of debt in order to invest in system. Yeah,
I think the majority of what they're investing is actually going to be debt, right? Because they're getting liquidity. They have issuance of shares. I think two years ago, they issued a new class of shares, which was called BIPC. So I think maybe some background, it's a bit complicated with the structure, but there are 4 listed shares. 2 trade on the Toronto Stock Exchange and 2 trade on the New York Stock Exchange. There's BIP, which is the LP units. That's like the limited partner units. They're the original. And then they created a new class of shares called BIPC, which is Brookfield Infrastructure Partners Corporation. So this isn't probably going to concern Singaporean investors or anyone really investing here in Asia. But for US investors, there are K1 forms that you've got to fill out if you buy LP units. And then the Corp units were really created for individual investors in the US and also institutions to buy the shares because there aren't tax issues related to owning those shares. But for most people in Asia, most people who don't have any US tax liabilities, it would make sense to just buy the original shares of Brookfield Infrastructure, BIP. That's on NYSE and they also do the equivalent on the Toronto Stock Exchange. So it depends, what you want to do. If you want to buy it in Canada, that's fine. The BIP shares do tend to trade at a slight premium to the BIP shares because of the demand from institutions and from US individual investors. So that's something to keep in mind. But there was a time when the premium was huge, but I think it's narrowed down now and it might be around sort of less than 10%. So I don't think it's too crazy. But obviously, if you're buying BIP shares, you'll get a higher yield if you've got, if it's cheaper. So it makes more sense if you don't have any tax liabilities in Asia to just buy the original shares.
Got it.
Yeah. Oh, and going back. So sorry, I think I went off track there.
We did.
Most of it, yeah.
It's good.
That was just background.
I don't even need to moderate this. You're just doing better.
Yeah. So that was background. No, so a lot of what they raise is they raise debt, right? So they're always issuing notes, they're issuing like convertible debt. But what they do is they make sure that they manage the tenures, like they hedge a lot of their FFO as well into US dollars. And they're refinancing obviously at lower rates. So last year they locked in about $9 billion in refinancing at super low rates, right? And they extended out the average duration maturity by debt duration by 5 years. And so that it totally turned out to be right because you obviously seen what the interest rate environment is looking like now. So these guys know what they're doing. They went in rock bottom interest rate environment, locked it in, refinanced everything, extended out the debt maturities. And so they don't really have any sizable debt maturities. They have pretty much no debt maturing this year. I think there's a portion next year, but they don't have any sizable debt maturities, I think, for the next 3 years. So they've got a very good, solid risk profile. They know how they manage their book and like they know how they manage their exposure risks and sort of debt. But it is, again, this is something that is, they're raising money. They rely on a low cost of capital and being able to find a higher return than the cost of capital by investing into projects, right? So that's the business model. So as I said, it is really a capital allocation and recycling play on infrastructure. And the key is that you don't really have access to this as an individual investor normally because you'd have to be invested in a private equity fund or a real estate infrastructure fund, which is only available to either accredited investors or institutions, right? So this is a listed play on infrastructure, which I think its scarcity value in the market is probably not really highlighted that much, but it is a scarce type of play on infrastructure because as an everyday investor like me and you, we can't access it, right? Unless you've got $10 million and you want to go into a private wealth fund or, you're managing Temasek or you're managing a pension fund in the US. Yeah. So this is an opportunity for retail investors to actually own a piece of this infrastructure, real assets that are generating cash flows. So I think that's the unique spin to this. It's something that is normally thought of as institutional only, but they've turned it into a vehicle that allows the everyday investor to buy into it if they want to.
Got it. And as of now, if you take a look at the stock, they never really had it down because 2008 was the biggest down and they came in 2009. So on the uplift.
On the uplift, yeah.
How did they fare over the last 2 years? I think that's probably the first question. And how are they faring now?
Yeah, so actually over the last 2 years, they've held up really, really well. They've outperformed over the past 1, 3, and 5 year period against the S&P. And as I mentioned, it's 13 over the past 13 years as well. But over the past 2 years, they've held up really well because it was surprising to see in the pandemic, they held their dividends stable. They still managed to grow FFO. And so it wasn't as though, again, as I'd mentioned earlier, if there's a massive crisis, as you saw in March of 2020, when everything just shuts down and people need to sell assets and get it off their books to raise cash, there's going to be a Brookfield Infrastructure waiting to buy those assets, right? It's like a knockdown price. So in a way, they managed to really take advantage of that first and second quarter in 2020 to pick up some really, really great assets and then build that out. And so they've actually performed really, really well because similar to REITs in Singapore, if you think about logistics REITs and industrial REITs, they weren't hit because everyone still needs those things to work. You need your Lazada or your Shopee delivery. That's going to be basically going through a logistics property. So those DPUs and those dividends didn't really get, they might have got cut a bit, but they really didn't get hammered as much as a retail REIT's dividends or a commercial REIT's dividends where everyone's working from home. So I think in a similar vein, Brookfield Infrastructure provides that because it's the assets that make the economy and the world basically turn, right? It's those ports, it's those pipelines that will flow if there's a pandemic, no matter what. If there's a recession, those things will still flow. And in this inflationary environment, I think that's what's helped them as well, because as people have thought about inflation not being transitory, and actually this is here to stay, as we've seen over the past 6-7 months with inflation figures, they have about 80-90% of their FFO tied to inflation-linked contracts, right? So it's inflation-linked. So they are seeing that. I mean, management in the Q4, in their 2021 report letter to shareholders, Sam Pollock was saying that he sees it as a tailwind to the business short term, because they're going to be able to raise those prices, with the contracts that they've got, with the inflation escalators that they've got in there. It's only going to turn dangerous if inflation becomes entrenched. But I think that's going to be the least of our problems. There's going to be a lot more issues. Inflation's entrenched for the next 10 years at 9%. So yeah. So I think that's the key for them, is they've managed to make the best of 2020, picking up some good deals.
Do you have any examples for us? What did they pick up?
Yeah. So I think in 2020, they bought a UK smart meter business, a portfolio of UK smart meters. And then they've also recently sold out of their North American district energy business for about 4.1 billion. Last year, they actually bought a majority stake and they took over IPL, which is Inter Pipeline, which is a midstream energy transporter, like a pipeline operator in Canada, but it serves a lot of the ports in the US and Canada for LNG. So it's actually one of the most crucial infrastructure and network sort of operators in the midstream energy and gas, like natural gas sector. And they've bought that out for about 12 billion with various partners. And they're aiming for an IRR of around 20% on that deal over the lifetime, over 12 years. And so I think that's going to be kind of deal that they really love, because I think they went in with Brookfield Asset Management, they went in with various other partners. They have an equity stake in that deal, but they didn't take on the whole deal themselves. And so they're leading that deal. And I think those types of opportunistic deals, and if they see opportunity and they see the tailwinds for those businesses, they'll pick them up. And so that was a big deal last year that they completed.
Okay.
Yeah.